Until a few months back, the buy China, sell India trade was not a mainstream worry, and investors were hardly prepared for a prolonged lull in the markets lasting a couple of months. But since then, three key factors have made the case for the buy China, sell India trade stronger. First, tariff threats from the US. Second, decline of the rupee against the US dollar. Third, China's show of strength in technology with DeepSeek AI. So it is not surprising that FIIs bit the bait and sold Indian stocks in droves over the past few months. Many FIIs are still choosing to head back to the US fearing tariff wars with China and India. Others are choosing to shift back funds from India to China given the promise of tech innovation. If you remember, in the late 1960s, the US restricted wheat exports to India. At that time, India was heavily dependent on the US for its massive food shortage. This crunch was a wake-up call which eventually led to the self-sufficiency through Green Revolution. 60 years later, India is again on the brink of facing such a situation. This time, instead of wheat, it is computer chips. These chips are needed by new age data centers running the AI revolution. But instead of the US, this time around, India may be compelled to look at China for an answer. The Chinese AI project DeepSeek, built on the basis of frugal innovation, could be the answer. So then, what are the chances that the buy China, sell India trade could be reversed soon? Very minimal in my opinion. Take a close look at the following two charts showing the change in the share of global industrial manufacturing over 30 years. This chart, shared by a recent UN paper, shows that at the start of the century, the US, Japan and Germany together held 44% of global industrial manufacturing. India's share in the year 2000 was 2%. As per the UN's projections, China alone will corner 45% of global industrial manufacturing by 2030. India's share, even in an optimistic scenario, will not cross 5%. Like China has shown in the case of manufacture of lithium batteries, drones, electric vehicles and semiconductor chips, its manufacturing dominance is here to stay, both in the case of procurement of raw material as well as the cost of finished goods. Indian manufacturing companies could try to attract investors keen to have a diversified presence across Asia or who wish to reduce their China dependence. But trying to trump China with technology or capacity in the near term will be easier said than done. However, when it comes to corporate governance, matters like information dissemination, shareholder activism and corporate governance, India wins hands down against China. Most of these factors are followed more seriously in India than in China. China's track record in information dissemination has never been great. Most of the large companies there are government owned. Often, the interest of the economy or the government takes precedence over the interest of the minority shareholders. China is also notorious for policy flip-flops, rampant speculation and withholding of information crucial to assessing business fundamentals. Coming to India, I believe that India is much closer to the US than to China in matters of long-term wealth creation and protecting the rights of minority shareholders. Hence, from a long-term perspective, India does look much better placed than China in terms of risk of permanent capital flight on a major scale, the way China sees every now and then. Therefore, investors looking to create wealth over the long term in Indian stocks need not bother about near-term impacts of buy China, sell India trade on the markets. Investors should select managements in India that have a consistent track record of shareholder value creation, so that whenever China shows its tendency to trample over corporate governance issues, these companies stand to win. Incidentally, in his latest letter to shareholders of Berkshire Hathaway, Warren Buffett outlined some key traits that he has seen in exemplary managements over more than half a century in the stock markets. According to him, managements that acknowledge mistakes could be trusted as they do not shy away from sharing problems in the business with minority shareholders. Managements that do not boast of academic degrees but demonstrate ability to innovate have better chance of creating wealth. Managements that are transparent and consistent in performance can steer the business even through the most difficult times. If you're wondering whether businesses with exemplary managements are ever available at cheap valuations, here's what Warren Buffett wrote. We own a small percentage of a dozen or so very large and highly profitable businesses with household names such as Apple, American Express, Coca-Cola, and Moody's. Many of these companies earn very high returns on the net tangible equity required for their operations. Understandably, really outstanding businesses are very seldom offered in their entirety, but small fractions of these gems can be purchased Monday to Friday on Wall Street, and very occasionally they sell at bargain prices. So get the cue, keep a watch list of stocks, high quality businesses with good quality managements, and take the opportunity to buy them during the market correction. We have a watch list of such companies ready on the Equitymaster screener. Hope you like this video. Thanks for watching.